Let's not be foolish. Let's not fool ourselves into thinking that we can predict prices, that there's actually any value whatsoever in price predictions. It's very interesting. When you look at search terms for YouTube, you see that a very, very common term that's being searched is price prediction. So Bitcoin price prediction, Ethereum price prediction, XRP price prediction, Solana price prediction. Everybody wants to get a prediction of where the price might be going. But the issue is we can't predict the price. How should we ever know what's going to happen with the price? We don't know the news that will come. We don't know the regulation that might get passed. We don't know anything. We don't know the demand of the ETFs that might come or not come. So how can we predict prices? We can't. But what we can do is we can make an assessment of whether or not an asset is currently cheap or expensive. So it's not a prediction about the price, it's simply an evaluation. Are we currently rather cheap? Are we currently rather expensive? So this does not mean, like the academics tend to say, that price developments are completely random, that the current price is fair, that it's an efficient market, and that in the end, all the knowledge that's public is already baked into the price. It's all completely fairly priced, and that any future price development is completely random. This is what a lot of academics think, right? They think that markets are already efficient. But when markets are so efficient, why do banks hire analysts? Why do hedge funds make so much money? Why are there some people that outperform the market that much, way beyond just statistical expectation? It's because the markets obviously are not 100% efficient, especially the new markets, especially the markets where there are not yet a lot of professional traders. When we look at crypto, when we look at meme coin trading, when we look at altcoin trading in general, it's not an efficient market. There's simply too many new investors in the market that simply throw something at an asset that has a lot of attention. So obviously there is some kind of inefficiency. And obviously if we are more skilled than the average market participant, we should be able to beat the market. But still, we can't predict where the price is going. Now there are different ways to evaluate whether or not we are currently cheap or expensive. In the stock market, it's comparatively straightforward because the stock market, the value of a stock, is determined by its future cash flows mainly. So whatever we expect the company to make in profit in the future, and then in return move this to the shareholders via dividends, whatever we expect for the company to do in the future, this then determines how much the company is worth and thus how much the shares are worth, because shares are simply just a representation in ownership in that company. So the value of a stock is simply the sum of all of the future cash flows. Now you have to discount the future cash flows that are further out in the future. So to be more exact, the value of a stock is the present value of all of its future cash flows. And you can actually value pretty much any asset that is cash flow driven by that. You can also value, say, a house based on this. So the value of a house is not necessarily its construction material, or say the land plus the construction material and the labor, etc. The value of a house really is determined by how much rent you can expect to get from that house. So if you were to rent out the house, you would get a regular cash flow. What's the sum of all of those cash flows if we discount them and we set them to the present value? What's the sum of that? That's then the present value of the house. And you can make your calculations based on this. You can play around with discount rates, etc. You can compare the future cash flows compared to the current market price. And that's then how you can derive the fair value of those traditional assets, right? Of cash flow bearing assets. Now this becomes a bit more tricky with assets that don't generate any cash flow, right? If you buy a rare car, or you buy a rare painting, or you buy gold, or you buy Bitcoin, there is no cash flow. So why is a Picasso worth millions and millions of dollars? Why does it go up in price? How fast should it go up in price? What's the fair value of a Picasso painting? It's very hard to say, right? The price is the demand versus the supply. And of course, when supply is low, demand is high, price tends to be high. And so what does this mean for Bitcoin, for example? The supply is pretty much clear, right? It's put into an algorithm. We know how much it inflates over time. It's now less than 1% per annum that gets newly mined every year. We know that on average more than 2% per annum gets lost in Bitcoin. So we actually have a shrinking supply over time. We know those kind of things. But those massive waves, right, those ups and downs in the Bitcoin price, they don't get generated by the supply, obviously, because it's predetermined. They 100% get determined by its demand. So obviously, the demand has to be fluctuating a lot. Otherwise, the price wouldn't go up and down that much.
This needs to go to 1 million, or March buyers now will make millions. This is how you get the clicks on YouTube, but this is not how you beat the market. To beat the market in crypto, you need to be better informed than the rest. You need to be better skilled than the rest. You need to do better blockchain analytics. You need to track other people's wallets and know what is the smart money doing. It's the boring educational content that forms skill that doesn't perform so well on YouTube though. That's why I created the premium membership. Feel free to check it out. We are tracking influencer wallets to find out what they are buying before promoting this on YouTube. We've got a lot of tutorials to help with on-chain analytics, to help with wallet discovery. And of course, there are also plenty of chats where we help each other and also one-on-one conversations with me. So I'm messaging every premium member one-on-one directly. Once you're joining, you will get a message from me and you have the opportunity to directly pick my brain. Feel free to check it out. thebitcointrader.com, link is down below.
So how can we then determine whether or not Bitcoin, for instance, is currently rather cheap or rather expensive? So we don't make a price prediction. We don't try to guess whether or not Bitcoin will be at 100K at the end of the year or not. We're not trying to do that. We're simply trying to look at the current price. Is it cheap or is it expensive if we just look at the near future and at the near past? And we can just compare this, right? Is it, for example, now cheaper than it was a year ago relative to its attention? Because we've already determined now that attention, that demand is creating those ups and downs. So we have to look at the price relative, say, to the attention, relative to how many eyeballs are probably on Bitcoin, right? That's potentially how to put it. And one way to do this is to, for example, compare what are the social metrics right now for Bitcoin, right? Are a lot of people searching for Bitcoin on Google? What does Google Trends say? Are there a lot of transactions on the Bitcoin blockchain? Are there a lot of people that watch YouTube channels? As in, is there maybe a lot of eyeballs on all kinds of different crypto content? How does that compare today to, let's say, 1 year ago? And for the YouTube views, I can tell you there's now way more YouTube views today than it was 1 year ago. So obviously there's more attention. At the same time, we also know that the price nowadays, right? The price today is way higher than 1 year ago. So there is a direct correlation, right? High attention, high price, low attention, low price, exactly how we would expect. And since attention comes in waves, right? Everybody has eyeballs on Bitcoin when it tends to go up, and nobody wants to know about crypto when it goes down. Since it comes in waves, we can say that comparatively speaking, now Bitcoin is more expensive than it was 1 year ago. What does that then in turn mean? It means that when we look at our portfolio, right, at the allocation in our portfolio with stock, with property, with bonds, with gold, with crypto, and we look at that mix, it means that we should have now less Bitcoin in our portfolio compared to 1 year ago. Even though the Bitcoin price went up, we should be rebalancing so that we are reflecting the higher price, relatively speaking, to 1 year ago. If the price is low, we should have a very strong allocation. We should be buying a lot. If the price is very high, then we should have a rather small allocation. We are not making here a prediction of where the price is going. We're simply just looking at fair value, right? When currently the house is very, very cheap relative to its future cash flows, and we should buy more of those kinds of houses. When it's rather expensive, we might consider selling some off in case we get a nice offer. It's the same kind of thinking about Bitcoin. And there are a lot of different metrics. The metrics I like to use a lot is the realized price. So that's an on-chain metric that's only available for crypto. It's not available in the traditional markets, but it shows us at what price, on average, did Bitcoin move for all of its wallets. So we know in aggregate, if currently the price, right, the price that Bitcoin has been traded at just in the last minute if the current price is higher or lower compared to what the overall market has. Now, why is this good? Because of human psychology, right? When everybody is currently in losses, but people expect that Bitcoin will stay around, then probably very few are going to sell. And the people with very strong conviction are very likely going to continue to dollar cost average in, thus creating a floor. So when the current price is below the realized price, we're going to see a floor at some point. And so that will be a time when Bitcoin tends to be rather cheap. And the opposite, right, when the current price is above the realized price, everybody is in profit, and they might in the end then also rebalance their portfolios as described before and take some of their profit, right, realize some of their profit. Currently, right, simply just search this in Google, right, search realized price Bitcoin. We are right now more than 2x above the realized price. So this also tells us again, right, most people are more than 100% in profit. Most people might be taking their profit at some point. We are not as cheap as we used to be 1 year ago. So this is, I think, how it makes most sense to look at the markets. It's not necessarily trying to think about this deterministically. It's not thinking about this, are we going to go up or down in the next month or in the next quarter, or maybe even in the next year. That doesn't really matter. What matters more, is it currently a good deal to buy with leverage heavily into Bitcoin? Should we take on debt to buy Bitcoin? And looking at those metrics, the answer is probably no. Does that also mean that we have to sell all of our Bitcoin? Of course not, because it's a very nice portfolio diversifier. And over the very long term, Bitcoin goes up. And we don't know whether or not that correction will come. We don't know whether or not people will take that profit. Something can be expensive and become even more expensive. Very much possible. And so instead of thinking about this deterministically, it makes, in my opinion, way more sense to think in terms of probabilities. Do I think it's more likely that Bitcoin will go up by 3x from here? Or do I think it's more likely that Bitcoin will go down by, say, 66%? What do I actually think is more likely? And if we just take those numbers, right, up 3x, how many people really think that Bitcoin will hit above 200K very soon? Not so many, right? I believe there's more people that think Bitcoin could, in the worst case scenario, hit, say, 25K. That's possible. This is what's within the volatility in the past, right? Bitcoin did go below the realized price, around 30% below the realized price historically. The realized price currently is at around 28K or so. So that's on the cards. So again, risk versus reward. I'm not saying we're crashing from here. I'm not telling you to sell all of your Bitcoin. I have a lot of Bitcoin as well. I did take profit, right? I did get more in my allocation to Bitcoin because of this massive rally. I rebalanced, I took profit, but I am prepared for a crash. If a crash happens, I have enough money in other asset classes that I can then sell potentially to take advantage of a crash. This is super, super important. It's very important to stay flexible no matter what comes. If it goes up, you should have enough allocation to be happy with the gains. If it goes down, you should have still enough money in other asset classes that you can buy that dip massively and then, of course, profit from the potential recovery. Because that's in the end the thesis, right? The thesis is that Bitcoin is a solid asset that will stay around potentially for the decades, but at least for the next, say, 5 to 10 years, right? This should be the minimum conviction you need to have in order to buy heavily into Bitcoin. If you're not yet part of our Telegram, feel free to join us. The link is down below. Looking very much forward to chatting with you. Feel free to also subscribe in case you're the first time here. A like would be very much appreciated as well. It helps the channel grow. See you next time. Bye-bye.